Let us get into it. I am glad you are here. The text you just saw on screen says it all. Week ending April 4, 2026. Recap. And that is exactly what we are delivering today. This channel exists for one reason: to take the most important financial news from the most respected outlets in the world and bring it all together into one clear, unbiased weekly breakdown. No noise, no agenda, just the information you need to stay informed and spot trends before they become obvious. Whether you are a seasoned investor or just starting to pay attention to markets, this recap is built for you. You will notice the tickers moving across your screen right now. That is intentional. Markets never stop moving, and neither should your awareness of them. So settle in, because we have a lot of ground to cover this week, and every section matters. With that clearly stated, let us get into this week's full recap. Everything you are about to hear in this video is created purely for educational and entertainment purposes only. Nothing presented here constitutes personalized investment advice of any kind. Investing in financial markets carries significant risk, including the potential loss of some or all of your capital. Past performance of any asset, sector, or strategy is never a guarantee of future results. Every viewer's financial situation is unique, and what makes sense for one person may be completely wrong for another. We strongly encourage you to do your own independent research, verify all facts and figures through trusted primary sources, and consult with a licensed financial professional before making any investment decisions. The information shared here is aggregated from major respected financial outlets and is intended to help you stay informed, not to direct your financial choices. Now that we have the important disclaimers out of the way, let us get into exactly what this week has in store for you. For the week ending April 4th, 2026, we have put together one of our most comprehensive recaps yet, and we want to make sure you know precisely what is coming. First, we are going into a full sector-by-sector breakdown covering energy, financials, technology, and defensive plays. After that, we are moving into our cryptocurrency update with a focused look at Bitcoin and Ethereum. From there, we will highlight specific stock and crypto names worth keeping on your radar heading into next week. And finally, we are closing with a forward-looking segment breaking down exactly what signals and developments you should be monitoring in the days ahead. Each section builds on the last, giving you a complete picture of where markets stand and where opportunities may be forming. Let us get started. So energy sector strength this week is real, but it comes wrapped in macro consequences that touch every corner of the market. And what a week it has been for oil markets. Throughout the week ending April 4th, 2026, crude oil prices have remained stubbornly elevated, refusing to pull back in any meaningful way. The primary driver behind this sustained pressure is ongoing geopolitical instability across the Middle East, a region that continues to create significant uncertainty for global energy supply chains. When tension persists in that part of the world, markets price in supply disruption risk, and that risk premium keeps oil elevated. Now here's why this matters beyond just the energy sector itself. Sustained high oil prices do not stay contained. They bleed directly into transportation costs, manufacturing inputs, and consumer goods pricing. With that energy backdrop firmly established, let us now zero in on two specific names worth keeping on your radar heading into next week. ExxonMobil and Chevron are both shaping up as potential momentum plays, particularly if oil prices manage to hold at these current elevated levels. Looking at their recent price action on the charts, both names have been trending constructively, reflecting the broader strength we have been seeing across the energy sector this week. However, and this is important, momentum can shift quickly in commodity-driven stocks. If oil prices begin to pull back even modestly, profit-taking in both Exxon and Chevron could accelerate fast. So while the setup looks interesting on the long side, we strongly encourage you to monitor both names closely for any early signs of reversal. As always on this channel, we want to highlight opportunity while keeping risk management front and center in every conversation. Shifting now to financials and rate-sensitive sectors, and the picture here requires some careful attention. Opening on the Federal Reserve Building and that animated interest rate timeline tells the story clearly. The Fed's decision to hold rates steady, combined with the continued higher-for-longer uncertainty narrative, is creating real and sustained pressure across two key areas: banks and real estate investment trusts. When rates stay elevated without a clear resolution timeline, lending margins get squeezed, borrowing costs remain punishing, and real estate valuations face persistent headwinds. That combination is not a friendly environment for either sector. On the specific names, JP Morgan and Bank of America are both worth approaching cautiously right now. These are strong institutions, no question, but strength does not make them immune to macro pressure. If you currently hold positions in either name, it is worth honestly evaluating whether reducing that exposure makes sense, particularly if rate uncertainty continues without any meaningful resolution heading into next week. Shifting now to technology and growth stocks, and this is where things get particularly interesting. Heading into the week ahead, the animated sector performance data tells a story of tension, specifically the push and pull between genuine artificial intelligence-driven optimism on one side and stubborn macro headwinds on the other. Here is the core problem for many tech names right now. Inflation risks have not fully disappeared, and rate sensitivity continues to weigh heavily on high multiple growth stocks. When rates stay elevated, the future earnings that justify those premium valuations become worth less in today's dollars, and that math is difficult to ignore. Now, within the sector, Nvidia continues to stand out as a relative bright spot. Its dominant positioning in artificial intelligence infrastructure gives it a fundamentally different demand profile compared to most peers. That said, broader caution across the tech sector remains warranted. Elevated valuations combined with the current macro environment create a challenging setup for many names beyond the clear artificial intelligence leaders. Shifting gears now, and this is where things get particularly interesting for risk-conscious investors. What we are seeing this week is a meaningful rotation of capital away from growth-oriented names and into the classic defensive plays, specifically utilities, consumer staples, healthcare, and gold. The animated flowcharts tell the story clearly. Money is moving deliberately and purposefully into safety. So why does this rotation make sense right now? Simply put, when inflation remains stubborn, geopolitical tensions stay elevated, and rate uncertainty lingers. Investors historically seek stability over speculation. Procter & Gamble stands out here as a consumer staples anchor. Its consistent dividend history and pricing power make it genuinely compelling in this environment. Duke Energy offers solid utility sector exposure, providing that reliable income stream investors crave during uncertain periods. And gold-related plays, whether through physical gold, exchange-traded funds, or mining stocks, serve as a dual hedge against both persistent inflation and ongoing geopolitical instability. These defensive positions deserve serious consideration heading into next week, are serving as the primary short-term price drivers for the entire digital asset space this week. Throughout the week ending April 4th, 2026, Bitcoin has been holding firmly in the mid to upper $60,000 range, a level that many analysts are watching closely as a key area of support. What is particularly noteworthy here is the continued stream of institutional capital flowing into Bitcoin exchange-traded funds, signaling that mainstream adoption is not slowing down. These ETF inflows are providing a meaningful demand floor beneath the current price action. Ethereum, meanwhile, is showing relative strength when compared to the broader altcoin market, which has faced considerably more selling pressure this week. Both assets are being heavily influenced by macro risk sentiment right now. So where does that leave you from an actionable standpoint with Bitcoin and Ethereum? Both remain what many analysts would describe as buy-on-dip candidates, but only if broader risk sentiment shows meaningful improvement and macro conditions begin to stabilize in a more convincing way. That is an important conditional. If the Federal Reserve signals any shift in tone or geopolitical tensions ease, both assets could see renewed upside momentum fairly quickly given the institutional interest already in place. However, the risks here are real and cannot be understated. Volatility tied to Fed commentary and geopolitical developments can move crypto markets sharply and without much warning. If you are considering any allocation to Bitcoin or Ethereum, sizing that position appropriately relative to your overall risk tolerance is absolutely essential. Do not overextend. Crypto continues to be one of the higher volatility asset classes available in the current environment, and that reality deserves serious respect before committing any capital. Stepping back and looking at everything we have covered this week, one thing becomes unmistakably clear. Oil prices, interest rate policy, and geopolitical tensions are not operating in isolation. They are actively feeding into one another, creating a macro environment that is simultaneously challenging and full of opportunity for investors who are paying close attention. Elevated oil prices are amplifying inflationary pressures, which in turn complicates the Federal Reserve's path forward on rates. That rate uncertainty is squeezing financials and growth names while simultaneously pushing capital toward defensive sectors and hard assets like gold. Geopolitical instability is adding another layer of unpredictability on top of all of this, keeping risk sentiment fragile across both equities and crypto markets. This week was defined by elevated uncertainty across multiple fronts. But uncertainty does not mean paralysis, it means precision. The investors who thrive in environments like this are the ones focused on the right signals, in the right sectors, at the right time. So let's bring it all together with some clear positioning ideas heading into next week. First, if geopolitical tensions continue and oil holds its current levels, selective energy exposure through ExxonMobil and Chevron remains worth considering as a momentum opportunity. Second, maintaining defensive positions in Procter & Gamble and Duke Energy is recommended for anyone prioritizing stability over growth in this uncertain environment. Third, if Federal Reserve uncertainty continues to grow without any clear resolution, reducing exposure to rate-sensitive names like JP Morgan and Bank of America is a prudent move worth evaluating based on your current portfolio. And finally, both Bitcoin and Ethereum are flagged as potential allocation opportunities on weakness, meaning if prices pull back, that could represent a reasonable entry point, provided you have appropriate risk management in place and your position sizing reflects the inherent volatility these assets carry. These are the key ideas to keep on your radar. That wraps up your full weekly recap for the week ending April 4th, 2026. The biggest themes this week were clear. Energy strength driven by geopolitical pressure, rate caution weighing on financials, defensive rotation into staples and utilities, and selective crypto opportunity for disciplined investors watching the right signals. Here is your bottom line for the week. In a market defined by uncertainty, clarity comes from following the macro forces, not the noise. Stay informed, stay disciplined, and invest smarter every single week. If this recap added value to your week, please hit that like button, subscribe to the channel, and turn on notifications so you never miss our midweek pulse dropping every Wednesday, our short every Friday, and the next full weekly recap the following Saturday. Now we want to hear from you. Drop a comment below and tell us what sector or stock you are watching heading into next week. We read every single one.